Hi, this is Sean Overton with OneStepRemove.com, and in this video we're discussing a scalping trading strategy that I developed. I originally set out to find a range trading strategy. It was through pure accident that I came across this scalping strategy, but it does work and it does survive trading costs. What I want to do in this video is to explain how I came up with the strategy, why it works, and then at the very end I'll give you the rules. You'll probably figure it out in the process. The reason that I have this graph up on the chart in Excel is I wanted to show you what my thought process was originally, and I want to explain why this strategy works. So I have one component, which is the 200 period simple moving average, and then I have the price of the Euro US dollar on the 5-minute chart. This graph, which represents all of the data from 2011, shows the frequency of the percent distance of the euro against the dollar away from its 200 period moving average on the 5-minute chart. And what you see here is that about 16% of the time the price is almost exactly equal to the moving average. About 12% of the time, 13% of the time, it's about 0.2% away. And then 6% of the time it's about 0.4% away. So you see there's a very rapid drop off as the distance away from the moving average increases. And what I found on the chart here is that if you look at this portion here, it moves almost in a nice straight line. And then right here around the 0.75 mark, 0.6, you get a totally different graph that moves more like this. So here you have a quote-unquote steep line, and you have here a quote-unquote flat line. So I wanted to look at what happens in this critical transition here, which happens to be exactly equal to 0.75%. That is, the price is 0.75% of the distance away from the moving average. And when I started testing strategies, I found that range trading strategies didn't work. But through a programming bug, I did find that when you enter as the price deviates away from this point, and then it crosses back above that point, you have a very large statistical edge, and that's what I'm going to go over. So to show you the back test in progress, this is for 2011 5-minute data on the euro against the US dollar. I push the back test and it's going to spit out the same results. So this is before trading costs. It makes $5,740 trading standard lots, and it has a profit factor of 2.18 with an 83% win rate on 108 trades. 108 trades, I think that's important because it's enough for you to feel confident in the conclusion. And the graph is very nice. You see we have a nice, well, it's not nice, there's nothing happening for about 6 months. And then in the last 6 months of 2011, it really starts to make its money. And I use here in the strategy a setting of 0.01. That's 1%. And you'll notice here that 1% is an important part of the graph. When I started looking here on the chart at 0.75%, the strategy works and it makes money, but not when you include trading costs. As you move further and further on this graph, the more and more profitable the strategy becomes. The reason I hesitate to trade everything out here is because the number of opportunities, obviously, dwindles very dramatically the further out you get. So the challenge is to find the sweet spot between the number of trades and the most profit and the likelihood of profit. Now, when you factor in trading costs, these numbers go down pretty substantially. So I'll include commission here, which I've set to about 2 pips, exactly to 2 pips. You'll notice the profit factor drops down to 1.24. Same number of trades, and the percent profitable has also dropped to about 66%. The profit is $1,420 trading against standard lots on the euro dollar. And then to show you that this thing actually survives when you walk it forward, which I did not model, I did all of my testing in 2011, the tests do hold up. The profit is, it looks way better and way higher, but the problem is the number of trades drops substantially. So the net profit here is $600, and you see that most of it comes from a handful of trades. When you get rid of the commission, just to show you that the metrics are the same as the original test, profit factor is ridiculous. The profit, or the percent profitable is really high at 88%. The number of trades has dropped, and the reason for that is the volatility has to happen in order for these opportunities to occur. So if volatility doesn't cooperate, we're just not going to get as many trades, which means more than likely not as much profit. I forgot the part where I'm going to show you how it works. So let's do this here in 2011 because there are a lot more setups and they're easier to find. So as this test runs, I'm going to scroll through this and show you some sample trade setups. This is the moving average envelope. This is 1% above, this is 1% below the 200 period moving average. And then you see here the price cross below the band. You just buy it and then you wait for it to cross and close above the lower band, at which point you exit. It happened here again and then you exit. And I'm going to scroll through here looking for opportunities where we went short. There we go. And then here's a few examples of some short trades. So it exits, exits, exits. And the reason is that these prices, again, the slope has changed on this curve, so it's kind of sticky around that point. You can think of this flat slope as meaning it's not very likely to change. And you know that over time it has the tendency to go back towards the average. So the fact that it's not changing very much and you have a stronger bias in the direction means that this strategy works. And if you have any questions about the strategy or you'd like to download the source code, you can find it at www.onestepremove.com. My name is Sean Overton. Thank you for listening.